But normally when you start hitting market tops, everyone's euphoric and everyone thinks it's going to last in perpetuity and it's going to, we're going to have markets forever that are going to be up, up, up. And they only go up and to the right on the charts, right?
Right.
And it's interesting because there's such a discrepancy between those that are feeling good about the market versus what the market is actually saying right now.
Don't get your financial news from political news sources, right? But I think the problem is that even the ones that we tout as financial sources, if it's a name that's well known by the average person out there, it's a political source. All the ones that are on TV, stuff like that, the ones that are truly financial sources that are as close to politically unbiased as possible, I would say the average person's never heard of that source. They're almost industry specific.
Thanks for joining us. Another edition of the Retirement Planning Happy Hour. Eric Douglas, Chris Vaughn, Family Wealth Planning Partners. Thanks for being here with us as we sample a really good bourbon today. A little bit of a unicorn, and so I'm always down to taste some unicorns here. I'll open up with the topic that we're going to be discussing today.
Yeah, go ahead.
We got a little bit of a random topic, but once again, all of our inspirations for our shows typically come from conversations we have with clients. And I'm starting to notice a theme recently, especially because the market just hit all-time highs again this week. And it's been hitting all-time highs repeatedly for really the last couple months, which is usually how it works. It's not like it usually happens one and then it just completely falls out, right? It usually continues to hit, all-time highs until the bull markets end, right? But we're definitely in the middle of a bull market ever since the Liberation Day, kind of bottom that we experienced back in April. But I'm starting to see signs of people becoming a little more bearish. And I'm starting to see people a little bit more worried about some type of a crash coming. And you're hearing a lot about it. And we've talked about this quote-unquote AI bubble. And, oh, my God, we're in for another, tech bubble,
the dot-com bubble thing.
The dot-com bubble, and everything's going to crash and everything's going to explode and it's not going to be good. And, so it seems like, and of course the media isn't helping feed the frenzy, right?
They're helping themselves.
Well, that's probably...
You say it all the time. Yep. Their job is to entertain and sell advertising, right?
Absolutely. So, I was starting to think, there's got to be some data behind this. And sure enough, we went ahead and found some and put some of it together around current investor sentiment across the board. And then to address some of that investor sentiment, we put together some information and some charts that kind of support maybe doing nothing.
And I'm going to go ahead and apologize to the people who are watching this up front. We will, as we go through these, we'll throw these charts up on the screen so you can see what we're talking about. If you really don't know how to read this stuff, and even if you do, when it first pops up, your eyes might cross. It's a little, it can be a little overwhelming. So that's where you just have to break down through the chart and kind of walk through what it means.
But it's definitely good to, see data sometimes from a third-party perspective and maybe, look at things through a more rational lens versus an emotional one. Yep. And when you actually look at a lot of the data and look at the numbers, there's data to support where we are right now, and maybe why we shouldn't be so worried about things that might potentially, possibly, maybe one day happen in the markets, but we don't know, right?
Yeah, and
we shouldn't spend our time worrying about things that we have no control over, right? Yeah. So with that being said, we got a little bit of a gift here, so I'll let you introduce the bourbon today.
Okay, so what we are drinking today is what we call E.H. Taylor. Now, Colonel E.H. Taylor was the gentleman who's a really fascinating story, by the way, but he is the guy who started the old-fired copper, I said that wrong, distillery, or OFC, back in the 19th century. That distillery is still there, but it's called Buffalo Trace now. It's been through many incarnations and people running it and owners, but E.H. Taylor's the one who started it, so this is a Buffalo Trace product. I can tell you there are multiple incarnations of E.H. Taylor, the most common of which is what we call small batch. So it's a blended whiskey. It is a true bottled and bond product, so that tells us it's 100 proof, along with some other things. And it is one of the most drinkable, consistent bourbons that you'll ever have.
It's very good.
Right? It's wonderful. Now, it's an allocated bourbon at this point in time, so you can't just walk in and get it. This is one of the different variations on it. So instead of blending a bunch of stuff together and then cutting it down to 100 proof in order to meet that bottled in bond rule. This one is it's a single barrel and it's barrel strength. It's uncut, right? Meaning there's no water been put in it. This is the way it came out of the barrel, and it's unfiltered. It's not uncommon in the bottom of a bottle like this to see little chunks of char that came out of the barrel when they pour it out. These have a tendency, and we literally opened this bottle and poured it out. I haven't tasted it yet. These have a tendency to be screaming hot. Not always. If one of us like slams into the wall here in a minute, you'll know.
I just made sure I had lunch, so
they
got a full stomach, yeah.
They do have a lot of flavor. There's a lot of nuance in these types of things because they haven't been cut. But sometimes it can be a little bit overwhelming flavors. You never really know what you're going to get. This particular one, are you ready? Mm-hmm. Is 127.3 proof. So this is up on the high ends. That's 63.65% alcohol in that bottle.
Let's rock, baby.
This is E.H. Taylor barrel. I'm sorry, let me say it right. Barrel proof.
Uh-huh. Now, I've had the small batch numerous times. Delicious.
Yeah.
So
I've had this before, just not this bottle, and they're all different, right?
I was going to ask if you had barrel proof before. Smells very good. I'll save my review for later. Well, maybe I don't need to because I think you just gave it away.
Wow. Okay, yeah, we'll talk about the review later. Holy cow. Okay. Yeah, I think I got a good bottle here. All right. So why don't you get us started on investor sentiment?
Yep.
Let's explain what that means to people.
Well, investor sentiment is obviously how you feel about the markets, right, and just the economy in general. And there's what's on here, what's called a bull-bear spread, meaning the spread between people that think there's, how you feel about it. It's basically
how you feel about the trajectory of the markets.
Yes,
right?
And there's really only three answers: bullish, bearish, or neutral.
Right.
And so you can see the number of neutral answers, and on this chart, it's about 22%, which is down from a national average of 33% of respondents typically feel neutral about the market. Right now, only 22% feel neutral. Okay. But there's a bull-bear spread, meaning if you take up the number of people that say they feel bullish and subtract the number of people that feel bearish, whatever that number is going to give you the bull-bear spread. And right now, that number is negative, meaning there's significantly more people that think that there is a bearish market, right, meaning they don't feel good about the economy.
They think it's going down.
They think it's going down versus the people that feel bullish about the economy. And that number right now is negative 22. Usually the average on that response is about 2%, meaning there's 2% more people that feel bullish versus bearish.
Right.
Usually the average is there's about half and half, give or take. That's pretty standard. But right now, this chart is going to vary wildly. Right. There's a lot of volatility in here depending upon market conditions. But right now, people are feeling very negative about the market. If there's a takeaway from this chart, which is interesting because once again, we just hit all-time highs this week in the stock market. So it's a little bit interesting to see that juxtaposition where, and this. Usually it's the opposite. Usually everyone's feeling a little bit more euphoric at market tops. And everyone's feeling great. And everyone, and usually it should be the opposite. This is probably the way people should feel, if we're being perfectly honest, at all-time highs. But normally when you start hitting market tops, everyone's euphoric and everyone thinks it's going to last in perpetuity and it's going to, we're going to have markets forever that are going to be up, up, up. And they only go up and to the right on the charts, right?
Right.
And it's interesting because there's such a discrepancy between those that are feeling good about the market versus what the market is actually saying right now. And that's what this investor sentiment chart is illustrating.
So just a couple of observations that I see on here. First of all, this is literally, it says the latest data point is yesterday, what we're looking at as we record this today. So we're dealing with recent data. It's a little bit hard in that if you look at that x-axis, it's in years and they're 2-year segments. So I'm thinking, if you figure out when we record this, because you're looking at the chart, we've had some very bad political news this week, actually multiple types of bad news, and it's been a little overwhelming. So if people are watching the news, be it business or investing type channels like CNBC, Fox Business, one of those, or they're just watching the regular news. It's been an overwhelmingly negative week. And just looking at this, I'm seeing a major league downtrend. So that's what people are being exposed to. I'm kind of trying to figure out the timing here. If you notice, right before current, we were down almost a negative 40 spread earlier this year. It's kind of hard to tell where that is on that x-axis.
Well, clearly that's going to be right around.
I'm thinking that's beginning of April. So that's your Liberation Day swing, causing people to think things were more bearish than they were bullish at the time. Just some other observations. End of 2024, it's actually very positive, up close to the 30-35% range. Well, we had an election cycle go through at the end of 2024. So what my point here is that a lot of this appears just at first glance to be guided by what people are hearing on the news, not based on the kind of data that I know you're getting ready to go into.
Well, it's very much guided by emotions.
Yeah.
Right. It's not guided by logic or not dictated by, rational thought. It's very much emotionally driven. And that's the idea, right? This is a chart showing investor sentiment. Sentiment says, how do you feel, right?
Exactly.
And that's what this is. And so it's just interesting. It's always interesting to me to see what the general public is thinking about the markets and investments in general and the way that the economy is moving, because I don't think most people truly understand or grasp the nuances of the market and what's actually happening out there. Because, and I say this all the time, and this has become kind of a new thing for me that I repeat a lot, do not get your economic news from political news sources.
Yep. That's
because
right.
Political news sources are by nature very emotional. They want to appeal to your emotions because they want you scared about something to get you to drive you to action, to go do something, to go protest something or go vote in a certain way, right? But if you step back and look at things a little bit more logically, there's some signs that maybe the world isn't ending.
Really, the sky's not falling? Holy cow. I want to add to what you were just saying there. You said, very good point, don't get your financial news from political news sources, right? But I think the problem is that even the ones that we tout as financial sources, if it's a name that's well known by the average person out there, it's a political source. All the ones that are on TV, stuff like that, the ones that are truly financial sources that are as close to politically unbiased as possible, I would say the average person's never heard of that source. They're almost industry specific.
That for sure, yes. And it's definitely becoming increasingly correlated.
Yes. There's that word again.
We talk about, correlation all the time, and we did a show about correlation between stocks and bonds recently. And there's definitely correlation between political and business news. And really they should not be intertwined as much as they are. But, hey, here we are, right? Free markets or something.
Another thing before we move on, because I know you want to, just looking at the same investor sentiment one, it's not the bull-bear spread that I find interesting. It's the neutral. Mm-hmm. You pointed out the average neutral. Now, the neutral being, I don't know if we're in a bull or a bear market. And I would argue that I, right now, kind of lean into this category. It's at 22%, so that's below average, but it means basically 1 in 5 of your major investors out there doesn't really know what's going to happen, and they have no feeling one way or another. I find that to be interesting, that has been below the average line for the better part of 2 years.
It's also it's also far less volatile,
Correct.
That neutral line.
Yeah.
So those that are neutral tend to stay neutral, and they don't get too terribly
wrapped up in the emotion,
reliance on what their emotions are telling them, at least as it relates to the markets and the economy. So that is definitely an interesting observation. It's also interesting though, even throughout, and this goes back to 2014, we've pretty much been in a straight bull market run ever since 2014. Yeah. And the neutral answers are always greater than the bull bear spread. You would think, given market conditions over the last decade, at some point, and I think there was one point there in into 2017, 2018, where there were definitely more bulls than neutrals.
Yeah, I see that one.
But it's interesting because there's just that you would think that the neutrals at some point would not always be kind of outnumber the others. But anyway, just an interesting observation. But how neutrals pretty much stay steady, but bulls and bears, man, if you're an emotional person, you're going to be all over the place. But maybe you shouldn't be all over the place, right? So let's start looking.
So back it up.
So let's start looking at some data. Well, actually, let me go. I know you want to go somewhere else, but I'm going to go here first.
All right.
I'm going to talk about U.S. economic growth. Because everyone is, talking about tariffs and inflation and, everything's bad in the economy. And yes, don't get me wrong. I went to Sam's Club a couple weeks ago and I left with like a $500 bill and I'm sitting here looking at my grocery cart.
Half of a grocery cart.
How is this worth $500? Yeah. And I totally understand and I totally relate and I get it. Things are more expensive. Here's a newsflash. Cost of goods and services is not going to come down. Mm-hmm. A lot of people, and we've had this discussion before, specifically as it relates to inflation, people think that prices are going to go back to what they were maybe before the inflation, and that will never happen. Inflation only talks about, it really only relates to the rate of change, so the rate of increase in the price of goods and services. Just because inflation is lowering, that doesn't mean prices of goods and services are coming down. That means the rate of increase is slowing.
Correct. And if the actual prices go down, that is not a decrease in inflation. That is deflation. Yeah. Which, to my knowledge, deflation has only occurred one time since World War II, and that was 2011 or something like that, which if you look back, not a good year. Deflation is a bad thing.
You don't want deflation. No. Absolutely. But when you look at the U.S. economic growth, because everyone seems to think that, we're in a period where everything is stagnating and nothing is growing. Well, that's absolutely not true. We had a little bit of, we had a negative growth quarter in Q1 of 2025, but that was sandwiched between two pretty good quarters.
Right.
In the most recent quarter's worth of data, the second quarter of 2025, we had a 3.3%, increase in GDP. Yep. Not bad.
I'll take that.
Especially when you look at the historical average of about 2.8%, mm-hmm. The most recent quarter ended was above the historical average.
Yeah.
And kind of right on line with what it's been really over the last several years. We had some really, really good years after 2020, after the market dropped tremendously, but that's because we were obviously rebounding from that significant drop in GDP right there and during the second quarter or the second quarter of 2020. But we rebounded mightily at the end of 2020, and we were kind of rebounding throughout 2021 as well.
Yeah, I would take, that's the obvious thing that sticks out when you're looking at this chart, that Q2 2020, Q3 2020. Those are extreme outliers caused by a unique situation that really was not a fair evaluation of what was going on in the markets or in the economy.
Or life in general.
Or life in general, right. Because we all know that was not what we were told it was. Yeah. I'll just be polite and say that. So take those are outliers. Throw those out. To your point, historical average is 2.8. So anytime you've got a quarter that is above 2.8, that's a good thing. It may not feel like it sometimes, but that's a good thing. And, quarter two, the most recent one, we're just a couple of weeks from the end of Q3 now, so the data's incomplete. At 3.3%, I'll take that. Mm-hmm. Give me 3.3 every single quarter, and I'll show you a very, very healthy economy.
Yeah, absolutely. And that's kind of in line with the current inflation rate, right? But what's interesting when you look at this chart of U.S. economic growth over the last several decades, it's amazing how resilient the economy is. Yeah. And so this goes back to the idea of zooming out. So whenever you're zoomed in and you're focused on the here and now, you're losing perspective. It's important to zoom out and look at data from a longer term perspective. And yes, we have some periods where we had negative market growth. You can see in the late 70s, early 80s. There was, the gas shortages and all that stuff. You can see the dot-com crash in the early 2000s and obviously the financial crisis in 2008, 2009. But the market always rebounds, and it's extremely this isn't market, this is the economy.
Economic growth.
Yeah, this is economic growth. But the economy always rebounds, and it's actually remarkably resilient over time. It's amazing how resilient the economy is over time. And so much of this investor sentiment that we were just talking about is so focused on the now that when you take a step back and look at the economy, it's going to be okay. We had one negative quarter last quarter. And a lot of that was kind of a freak out around the tariff stuff and the Liberation Day and all that stuff. But really, not since 2022 have we had 2 consecutive quarters of, I think one was negative and then one was flat in 2022. But ultimately, we're pretty much on pace to continue what we've been doing. It's not like we've really had much variance throughout in most of the last several decades within the growth of the economy. It's been fairly steady.
Well, you bring up a good word, and I like the way that you say it's resilient. But you have to think about what creates our economy. And there will be people out there who do not like this. I know you and I agree. This is what capitalism is supposed to do. The whole concept here is that people are going to go behave. They're going to run their businesses. They're going to price their services and products in such a way that it benefits them. But they have to do that in such a way that the consumer that they're after is willing to do business with them. Now, you take that on a macro level, and what you get is when bad things happen, people figure out how to improve that, right? That's the beauty of the system that we have. So that's the reason when you have these bad times, and there's always going to be some negatives, it always springs back. It's always resilient. It's always elastic because that's the way it's designed to be.
Well, it's also the way that, humans, for the most part,
correct,
especially Americans, I should note, we're incredibly resilient, and we tend to, make the best out of bad situations, and we adapt. Right? That's what people do. That's what humans do. We adapt. So if markets change, we need to change our behavior. And by and large, when you have a capitalist society where everyone is incentivized for their own well-being,
bingo,
they're incentivized for their own well-being to figure it out and adapt, they're going to do it. And so that's one of the things to highlight. Like, it's just interesting when you look at the U.S. economic growth over the last several years juxtaposed with investor sentiment, especially as it is right now, coming off of a good quarter's worth of data, coming off of the market hitting an all-time high, how many people are kind of in this bearish mindset.
Right.
And I find that very, very interesting. And really, I think really the only conclusion, which you already alluded to, is a lot of it's probably coming from just too much TV watching, too much, and there's definitely news. There's definitely, bad news out there. There's always bad news. There's definitely been a little bit of more bad news over the last couple of weeks, and we're not going to go into that. But none of that is really related to the economy or business.
And understand, if you are a news junkie, we're not faulting you. I'm a news junkie.
Oh,
I probably consume 2 hours, maybe 3 hours of reading or watching every day on a slow day. I know you're exactly the same way, even though we consume our data and our media differently. We're just as bad as anybody else, but it's remembering to read through what you're hearing and reading and seeing because, to your point, Eric, the media's job is to entertain and sell advertising. And the old concept of if it bleeds, it leads is very true regardless of what subject the media is reporting on. People are automatically going to tune in more when it's a negative than when it's a positive.
For sure. Yep.
All right, which one are we moving to next?
Well, let's talk about market corrections and recoveries because
all right.
I want to move here next because, let's say we are bearish. Right?
Right.
And everyone is bearish, and let's say we're due for another correction. And quite frankly, it wouldn't surprise me if we had one through the end of the year. We already had one earlier this year. We had a pretty good little correction. It was down, 14, 15%, maybe even a little bit more than that at one point, depending upon the index that you watch. But let's say we have another market correction this year, okay? The average market correction is about 14.3% on average across the market history. So if the market drops on average about 14%.
And by definition, a correction is a 10% downturn from recent highs, correct?
Correct. Yes. A 10% drop is considered a correction. A bear market is when you have a 20% drop.
Yeah.
So that's the distinction to make there. What's interesting, though, is the average recovery from that correction only takes 4 months.
Wow.
It doesn't necessarily take too terribly long to recover from an average correction. Now, once again, there are obviously, there's
exceptions.
There's always exceptions to the rule, right? Going back to 2008, 2009, it definitely took longer than 4 months to recover from that drop, but that was also not an average correction. So, obviously the dot-com bubble and things like that, that was not an average correction. That was a full bear market. That was a full drawdown. But in average correction, which happens about every 18 to 19 months, we recover from pretty quickly. And most people don't even remember them very well.
Well, that's one of the things that was popping through my head as we were saying. You were talking about 2008, 2009. You were talking about dot-com. Those were not your normal corrections. Those were recessions. Those were bear markets. A correction is actually far more common than what most people realize. The chart lays it out. I would not have guessed this before we looked at this chart, that the average recovery time is 4 months. It takes a couple, 3 weeks for the correction to happen. You usually get some really bad news if you're watching CNBC, and then next thing you know, you're out of it. And I'm kind of leading into the next chart a little bit, but it's the big problem with these is people who are trying to manage their own accounts and they're trying to trade in them on a regular basis. And I'm not talking about the day traders. I'm just talking about people who look at their 401k too frequently and too closely for their own, health. They don't realize, this is where heart problems come from, right? If you're looking at it that closely, that frequently, you see that downturn, that quick downturn that is typical with corrections. And they don't realize what happens if they just stay where they are. We told the story last week or week before that. We talked about what happened in 2008 where people panicked because it was such a big downturn, excuse me. In most cases, 4 months, corrections happen every 3 to 4 years on average, and they recover in 4 months. So what's that tell you? This is a common part of the economy. It is a feature of the way that the markets work.
It's not a bug.
It's not a bug. This is normal. So what should you do when they happen? Nothing.
Most of the time.
Nothing.
Yeah.
Just leave it alone. You make the comment when we're teaching workshops a lot. The best thing that you can do for the accumulation of wealth in your investments, right? Be it brokerage accounts or IRAs or whatever the case is. Save it, invest it, leave it alone. Because to this point, when we do have those occasional downturns, 4 months you're recovered. If you're not paying attention, if you're leaving it alone, you've recovered most likely before you realized you'd gone down.
Yep.
That's a whole lot healthier way to go about living your life.
Yep. And the other thing, too, that's inherent in all of this is knowing when we hit the bottom. So if the average market correction is 14.3% on a drawdown, do you know when that 14.3% is on average, or when we hit the bottom? I say bottom, I'm using air quotes here, the quote unquote bottom of the correction. You have no way of knowing.
I do not have that crystal ball.
No one knows when we've hit the bottom until until we're looking well into the rearview mirror, right? There's no way to tell in the moment, because usually in the moment when the markets have drawn down the most that they're going to be drawn down, that's when you feel the most bearish, and that's when you feel the most anxious about investing, and that's usually when you freeze and don't do anything, or you capitulate and say, I'm done, I take my money out of the market, and then guess what happens? The recovery.
And you miss it, which leads into the next chart. But before you say that, just to give you an idea of just how non-crystal ball this world is, trying to figure out when that bottom, that 14.8% or whatever it is, or 14.3% is. In our investment committee meetings, you've got everybody in that room is very like-minded. They're all very knowledgeable, and they all watch this stuff on a regular basis because, quite frankly, it's part of our job, right? I don't remember the last time we talked about, do we think the market's getting ready to make a turn in its direction? It's currently going up. When do we think it's going to go down? It's currently going down. When do we think it's going to go back up? I don't remember a single time where we all agreed. In fact, it's usually completely different opinions on what we think is going to happen based on the same data. And I tell you that to say, here's learned people who pay attention to this all the time, and they can't agree on when that's going to happen, much less how bad it's going to get or how good it's going to get before it makes a change.
There have been very, very smart people that have been calling the next 2008 since 2008.
Yes, exactly right.
And there have been some very, very smart people that have made a lot of money predicting the next 2008. That has never occurred.
Yeah.
And people, names that you know, names that are respected in our industry, names that are respected outside of our industry, that are always calling, they're always waiting for the next big market crash so they can say that they were right. And they will spend years talking.
And what happens when they say they were right? They sell a lot of books, and they get a lot of TV time that in many cases they get paid to come on and give their opinion. There's an ulterior motive behind making those predictions on a regular basis. And just keep that in mind when you're consuming that content.
And if I was a cynic, there are some really big names in the industry sometimes that might have some type of a short or a long position in one direction, and they will go on TV and try to will the market in that direction.
Because they have a bullhorn in many cases. Yep.
If I was a cynic, I would say that might be something that might occur on a more regular basis than people are comfortable to admit.
You don't have a cynical bone in your body, neither do I.
But that would not be me, right? So, but all that to say, at the end of the day, nobody knows anything. Nobody knows what's going to happen with the market. No one can ever time the bottom of the market repeatedly.
Yeah, right? you can. I mean, lucky. I've done it. You've done it, but it's been as much luck as it has been research.
Exactly,
and it's not going to be something that's repeatable with any amount of accuracy.
Yep. So
that tees up this next chart, which this is my favorite of the types of charts that we look at. So walk us through this one.
So this is just showing the impact of staying invested, okay, and the impact of missing the best days in the market. And I'm going to come back to missing the best days because I'm going to talk about when the best days usually occur.
Okay.
But the impact of missing the best market days over the past 25 years based on an initial $1,000 investment using S&P 500 returns.
Okay.
So if you took $1,000 invested in the market 25 years ago and left it alone and did absolutely nothing, it is now worth over $5,400. Yeah, $5,400, $5,422. If you missed the one best day, right? If you missed the best day each year, that is only $4,859. So if you missed one day per year, that is the best day of the year. That's going to cost you in this scenario about $600,
which is a pretty large percentage of when you think about the grand scheme of things. Yeah.
If you were to miss the best 5 days, that account is only going to be worth $3,300. If you miss the best 10 days, 2.4. If you miss the best 20, 1.4. If you miss the best 30, 903, you've actually lost money now.
I was going to say, there's the cutoff because now we're on a negative.
Right, and if you miss the best 40 days, you're now down to 607.
Yeah.
So there is a definite incentive to staying invested during these market corrections and not overreacting. Why are we talking about staying invested and making sure that you do not miss the best days? When do you think the best days in the market occur?
Usually the day after the worst day.
Exactly.
Right.
Exactly. So usually it's in the rebound. And so if you try to time the bottom, and if you miss or incorrectly guess exactly when the bottom is going to occur, you have to be invested at the bottom of the market to experience the returns that you're going to get in the best days.
Yeah.
Because the best days in the market always occur pretty much right after the worst days.
Yeah.
It's always on the run back up. It's always on the rebound when we experience the best days. That's when you're going to have the biggest. Some economic data is going to come out. It's going to be somewhat favorable in the other direction, and everyone's going to, I don't want to say overreact, but everyone's going to react at the same time at the same news. And by the time you even know that the good economic data is out, the market has already reacted. So you're still feeling ambivalent or anxious about the market. Well, good data has already come out, and you don't have time to react to it because the market has already absorbed it, and you've already missed the best day if you sold out because you were scared.
We were speaking the other day about the gold rushes, the Yukon gold rush and the California gold rush and things of that nature, and we were talking about who really made the money. And we were talking about the people who got there first, and we were talking about the people who sold the shovels to the people who got there later, right? And I think that kind of applies to this case. The gold rush, the vast majority of wealth that was made by people who were actually finding gold were the very first people. Most of the real wealth was gone by the time news got back to the cities in the East, right? It was pretty much all gone. I think that it's kind of a similar situation here. You have to be there when it starts going back up. Not by that day, right? Because you missed part of it. You have to be there when it starts going back up. We were watching the other day. You actually brought one up. There was some news that came out, and Oracle stock just skyrocketed in one day. I don't remember what the number was.
Oh, was that 40%?
40% in one day, 40%, right? And I didn't go, ooh, I'm going to go buy some Oracle stock. I said, wow, I wish I'd have bought some Oracle stock yesterday, but I didn't go buy any because I missed the run up on that one. Right.
And
now
and anybody that wasn't already invested in it, because it came out of left field, they came out with an earnings report, and they basically came out because they basically helped build the data centers for AI, right? And they had and I don't remember the details, so forgive me if I'm not 100% correct, but basically their back orders right now, they haven't even been paid for several. All these jobs that they have lined up for the next couple of quarters. Right. And it's like, it's extreme. They've never had more business than they have right now, basically. They're just, making money hand over foot because of all these people that are building AI data centers. And that's the market that they're in. So they just kind of happen to be a right place, right time kind of company. They're the company that's selling the shovels to the gold miners.
Yep.
That's what they do. And so they are killing it right now, but you've already missed the best day.
Right. Now, what we're talking about here is an individual stock.
Yes.
Right. But for the typical investor out there, and we say with retirement funds, you should never be buying individual stocks. You should be buying portfolio, right? Yeah. Okay, so that kind of goes back to what we were talking about here. Put your money in, put it in a good portfolio, and leave it alone, because I don't know when the next big day is going to be or the bad day, but I do know the stats are pretty clear. If you put it in there and you leave it the hell alone, you'll be better off than if you sit here and try to figure it out. Mm-hmm. And oh, by the way, if you're leaving it alone, you're actually going to go out and live your life. I heard the comment over all the news this week. Sometimes we need to take our shoes off and go walk in the grass, right? I think that kind of applies here too. Mm-hmm. Put it in there and leave it alone and go out and enjoy your life. And you will be a much, much happier person than when you're sitting here trying to figure this stuff out.
Absolutely. So
there's another chart I wanted to talk about, and I don't think we printed it out. We'll get to it. But I want to take a stop real quick and come back, because both of us have been sitting here making faces while the other one was talking. Let's go back and talk about E.H. Taylor Barrel Proof. Your opinion.
There's a ton of flavor. There's a lot going on with this one. It's not too hot. It's not.
It doesn't even approach as hot as it sounds.
For
not even close.
For 127, this goes down remarkably smooth.
I'd have said 110 if I didn't know what I was drinking.
Yeah, I mean, there's a little bit of chew on it, but it's not bad. I don't. God, I hate to sound like a bourbon snob.
Go ahead. You can.
But every sip is a little bit different.
Yeah.
Is very complex. Like I'm not getting really the same taste every time. Part of that maybe depends upon how much maybe I swish it around, and I just added a drop of water, so that changes it a little bit.
I'd say I've added 5 or 6 drops at this point in time, and I've been tasting in between each couple of them. The flavor actually has not changed a lot.
Yeah,
but it has changed a little. It's not a dramatic thing like it is with some bourbons. Holy cow, this is delicious though.
Yeah,
and to your point, there's I'm not picking up a lot of different flavors. There are definitely 4 or 5 huge caramel, huge butterscotch, maybe some cherry, some citrus, very faint kind of stuff. But what I'm picking up is that there is a lot of that flavor, and it's really good. That's not a complaint by any stretch. I don't know if I've just nailed a good bottle or if the barrel proof is just always this good. I've had it multiple times. I don't think I've ever set 2 bottles next to each other and tasted them to see if I liked one better than the other. But wow, if you can get your hands on this, you are not going to be disappointed.
It's definitely very good. I like it a lot.
Yeah. But the biggest thing is 127 something proof. I think we said 127.3. This doesn't even approach tasting like it's got that much heat in it. So
yeah, it's definitely remarkably smooth for a 127.
Wow.
I mean, it's very smooth for like a 110, 100. So,
but do remember, it is still 127 proof. So sitting around and drinking a bunch of this and then going somewhere is probably not a very good idea.
Yes. So we are on a limit. We limit ourselves during the day.
This is all we get today. Okay, so I want to move back to that last chart. So before we started recording today, you and I were talking about the dot-com bubble. Mm-hmm. There is a fear that the whole AI buildup is another version of the dot-com bubble. We've discussed this before. AI is currently probably the biggest driver in what is causing a lot of companies to for their stock value, or their stock price, I should say, to go up. We talked about the Mag 7, a lot of which is AI driven, and the run-up that they've had ever since COVID. But the biggest issue was in the dot-com bubble burst. The issue was people were buying these stocks of all these companies. That's not the one I was thinking of, but it was showing EPS.
Yep.
In the dot-com bubble, people were buying these stocks of all these thousands of different companies that were going to take advantage of the new technology that we now know to be the internet, right? Because that came out in the 90s. If you go back and you look at the S&P 500s in the 90s, especially the second half of the 90s, that's the one. Just huge, huge run-ups. The problem was the companies that people were frequently buying, the stocks that they were buying, they were valued based on what they could create in wealth, what these companies might be worth. So people were trying to do the gold prospecting, if you will, back to our last analogy. They were trying to do that gold prospecting, not knowing if there was actually gold in that area or not. And when we found out that most of those companies were not capable of, well, most of them weren't even capable of generating a profit, much less generating real ongoing wealth, that was what caused the dot-com bubble to burst. So the concern is, what is it like that this time? And you brought up a great point, and I'll let you kind of walk through what the EPS was, but this is definitely not what 2000, 2001, 2002 was.
Well, and we'll talk about some of the other differences between the two, but when you look at the tech bubble peak back in the early 2000s, the earnings per share on average in the S&P 500 was about $53.
Okay.
Right now, the earnings per share is about $258.
So 5 times greater.
Yeah. Now, obviously inflation and things like that are coming into effect, but companies are far more efficient than they were back then. We can talk about why they're more efficient. Part of it's because of the dot-com era, right? So, internet technology, and now with AI, companies are becoming increasingly far more efficient. And we're actually increasing more and more, or we're increasing the jobs that are, I guess, quote unquote, white collar,
right,
if you will. Because we've shipped off a lot of the manufacturing lower, I don't want to say lower value jobs, but you know what I mean.
Lower wage jobs, traditionally lower wage.
And so typically we're creating more higher wage jobs because companies are becoming far more efficient and they're becoming far more profitable. They're so much more profitable than they were back then. So that's certainly something to note. There was another chart that I was looking at when you look at earnings growth. The trailing 12 months earnings per share right now is up 10.4%. That's greater than it was during the peak of the dot-com era. Right? Companies are making money. This isn't speculative investments. This is not speculative investing in companies that might potentially be something one day because people are trying to, hop on this internet train and we don't know where it's going to go. The companies that are investing heavily in AI and the companies that are capitalizing on it are the names that you know. Right.
It's not that nobody company that you've heard of. This is a profitable company you're dealing with already.
And it's always interesting when people talk about, it's just all these technology companies. What, you mean like Amazon? Amazon, the company that owns
everything.
It owns Prime Video, so it owns a streaming service. It owns Prime Music, so it owns a music streaming service. It owns a video streaming service. It owns Whole Foods. It owns grocery stores.
The biggest one is, and I'm the acronyms popped out of my head. It's their actual internet access service.
Amazon Web Services.
Yes, AWS. Thank you. That's what I was trying to think of.
That's a massive part of what they do.
Huge, and people don't even know what it is.
People just think, oh, that's, I get Amazon's the retailer. I get stuff online.
That's where I buy the stuff that I don't want to go to the store for.
Yeah, and they've also basically created their own fleet. They have their own they've created their own UPS.
Yes, they have.
So
in not just aircraft, but in vehicles, all kinds of stuff.
Amazon just opened a huge hub. We're in Kentucky, so at the Cincinnati airport, they just opened a huge hub, just like UPS has a major hub in Louisville. Amazon just opened a huge hub up at the Cincinnati airport, which is northern Kentucky, by the way, not in Ohio. But NVIDIA, everyone says, oh, NVIDIA's got to slow down, and at some point they probably will. But right now they don't really right now they don't have a true competitor.
Right.
And they're making money hand over fist because they have the best product in the space. Mm-hmm. And if you're an AI company and you need chips, NVIDIA is the best place to go for that. And no one can match the quality of what they're doing right now.
And I would add on to this, and this is one of those other things that is a differentiator between now and the tech bubble that we had. A lot of people, if you're not in the computer space, you go, I didn't hear about NVIDIA till 2 years ago. I'd never heard of this company. They just came out of nowhere. No, they didn't. They've been making chips that people who are into computers have known about for 30 years. In fact, they were the best video chip manufacturer back when the industry was really starting to take off. They were already well positioned. What they've simply done is continue to develop better than the competition that's out there. This is not a new company. That's why they're doing so well. They've got the money to invest in the R&D, and they've done a good job with it. And to your point, they're outpacing what little competition they have so well. There's no chance that they're going to slow down, barring something that is completely unforeseeable.
So I think sometimes what gets lost in the news of the day, where everyone's preying on your emotions and everyone's scared about this or that. And right now it seems to be inflation and it seems to be tariffs, which I'm not discounting inflation specifically because, yes, we're all feeling it. I'm feeling it. I feel it. I got 3 kids to feed, right? I feel it every time I go to the grocery. And I got 2 that are going into high school, and that ain't going to be cheap, right? So, I completely understand having issues with inflation, but when you step back and look at the economy as a whole, companies are making money, okay?
Yep.
And if you're in really the way to make money in this economy is to be invested, to be an owner, okay? Those that get left behind are the ones that are either afraid to play the game, and they don't want to enter the game. They don't want to, they don't want to play the game. They don't want to set foot in the arena, so to speak, right? Mm-hmm. They're scared to get ownership. They're scared to buy ownership. And sometimes it gets lost to a lot of people that the stock market is this fancy thing that it just seems unattainable to a lot of people. And I understand maybe to some people it can be, and I understand why, but you need to get in the arena. Because the way to make money in this world is to be an owner. And the stock market at the end of the day is ownership in the biggest and best companies in the world. If you own the S&P 500 index fund, you own shares of the biggest 500 companies in the United States.
And they didn't get to be the biggest by dumb luck or by being bad at what they do. You're investing in good quality companies when you do that.
These are not I hate when people refer to the stock market as speculative investing. It's not speculative. You are investing in companies that have a track record of success that are killing it for the most part. And right now, the S&P 500 across the board, earnings are growing. The S&P 500, the companies in the S&P 500 are making more money. They're definitely making more above the historical average. Right now, they're doing well. And so it's important to remember that fact and take a step back and view this, from more of a 30,000-foot view, that not everything is crashing. Sometimes we get so focused on, one or two things, and right now, once again, it seems to be inflation and tariffs. That's what people are talking about. Right. That they lose sight of the fact that the economy is growing. Companies are still making money. People are still spending money. It's up to you to make sure that you're playing the game.
Yep.
And you're a part of that.
Get in and play.
So
I think Nike said just do it.
Do it.
Just kind of appropriate. All right, let's wrap this up. Let's one more final thing on the bourbon I want to go into. E.H. Taylor is known for their packaging. They come with these wonderful cardboard tubes to protect it. Makes for great displays. If you ever get an opportunity to go to someone's home where they have a nice bourbon collection. The E.H. Taylors are always on the back row because these big, tall things just kind of stand out. You can't put them in front of anything else. But a word of caution. When you go into a store and you manage to get in good with the owner and you say, hey, you got anything cool under the counter? These tubes are not sealed. And it's very easy to take a bottle of E.H. Taylor small batch, which is exceptionally good, but it's not the same thing and it's not as expensive, and switch this in here and put that cap back on. And you can walk out of the store with it and you realize that you've bought the wrong thing and you walk back in which case they're going to say, no, you swapped that in your car, right? So just make sure if you get your hands on one of these, hopefully they will become more common. Pull the bottle out of the tube and look at the label on the bottle. Make sure that it actually is what you want. I do that every time, and I do it in front of the owner, the liquor store owner that I get most of my stuff from. He knows I'm going to check. It's not personal; it's business, folks. But from the younger crowd likes to unbox things and they like presentation. E.H. Taylor is one of the best presentations. You're just not going to find much better than the infamous tube that they come in.
No, it's a great bottle. I've had small batch a number of times. I like it a lot. This is very good as well.
I will tell you that the ones that you're going to find the most often, obviously the barrel proof is the more rare of the ones that are out there. Small batch is the most common. There is a single barrel and a rye that are out there. The rye is outstanding. If you haven't had it and you like rye, it's really good. If you're kind of wishy-washy on rye, like I know you are, Eric, it's a really good rye. You would enjoy that. I will make a comment on the single barrel. Most bourbon junkies will tell you that the small batch is better than the single barrel. It's just because of the blending that they do, you get a better consistency. It's just a better product. But I've never had an E.H. Taylor that was disappointing. Not one time.
Not at all. Good pick. Good bourbon. Good conversation. Thanks for joining us, and we'll see you next time.